And this example makes it crystal clear. $25,000 in interest is value you've created, but it did not come back to you, it went to the bank. John ends up 2.6 million ahead, not from buying extra equipment, not from doing more jobs, not from making high returns elsewhere, not from taking any additional risk, but from changing the flow of money. Just from financing his own purchases, maintaining control, and reclaiming the interest that would have gone to the bank, he was able to produce an additional 2.6 million. Okay, so over the course of the next 30 minutes, I want to walk through how you can run your business without the bank. As you can see on the screen, it says logging without the bank. That's exactly what this presentation is going to be about, how to create a system of financing and savings that puts you back in control and allows you to reap additional benefits from your business that someone else is currently profiting from. But first, I want to give a quick background on me and my firm. I'm part of a father and son team at Chapman Financial. We bring over 14 years of experience helping individuals and business owners take back control of their finances. We are proud practitioners of the infinite banking concept, and everything I'm going to show you today comes from what we personally do in our own lives and what we've been helping clients do over the past 14 years. So at Chapman Financial, we believe there are three core issues that plague most Americans when it comes to their finances. The first one is a low personal savings rate. In 2023, the average personal savings rate in the US was just 4.1%. That means only 4.1% of disposable income went towards savings, whether that's in a traditional savings account, a money market brokerage account, or even just cash in a safe. That number is alarmingly low, and we're on a mission to help our clients raise it, not just for emergencies, but for long-term financial control. Second one we see is an over-reliance on banks for financing. In today's world, if you want to buy a car, you go to the bank. If you need to finance equipment or get a line of credit for your business, you go to the bank. Now, that access to liquidity is helpful because it gives you funds when you need them, but it does come at a cost. Interest payments and a loss of control. The bank sets the terms, not you. The bank sets the interest rate, not you. And we believe you should be in the driver's seat when it comes to accessing and using your money. And the third one is an over-reliance on tax-deferred retirement plans. We also see too many people putting the bulk of their retirement savings into tax-deferred vehicles like 401ks and IRAs. But here's the question. If you believe there is a possibility that taxes could go up in the future, wouldn't it be prudent to hedge against that possibility? It's not that these plans don't have a place. I personally have a portion of my retirement in a tax-deferred account, but it should never be the majority. Relying too heavily on these accounts could leave you vulnerable to possible future increases in tax rates and could give you less flexibility when you need income in retirement. So I'm not simply naming these problems. I'm bringing them to the surface because the solution I'm about to show you tackles all three of them at once. This presentation is about how to address these issues simultaneously using a proven strategy that gives you more control, more access to capital, and a more sure and efficient financial future. So let's go ahead and dive in. What you're looking at here is a typical revenue stream and budget layout for the average American login operation. On the left side, we see 2.7 million in annual revenue, and as we follow the flow to the right, we see where that money goes. There's 500,000 allocated for labor, another 500,000 for equipment principal payments, 75,000 in interest payments, and then going on down the line there's a few more. And then there's 250,000 set aside for depreciation. So after accounting for 125,000 in taxes, what remains is a net after-tax profit of 375,000. Now, what we're aiming to do here and how we're going to address the three key issues I mentioned on the previous slide is very straightforward. We're simply going to take the equipment interest payments and move them down into the net profit section of your balance sheet. We're not trying to change your operation. We're not coming in promising better interest rates or renegotiated terms, and we're certainly not trying to optimize the harvesting, loading, or processing side of your business. What we're doing is making your financing function more efficient. That's the only lever we're pulling. This is what we've been doing successfully for the past 14 years, helping clients improve their financial outcomes without touching the core of their operation, and that's exactly what this presentation is about. So to frame this properly, I want to start from the very basics. Now, none of this is going to be new to you. This is just starting from square one and building from there. So let's look at traditional equipment financing and how it typically works in the real world. Here we have a Tigercat 220E priced at $300,000. Standard financing calls for a 20% down payment, which comes out to $60,000. Now, keep in mind, part or possibly most of that down payment is likely going to be covered by a trade-in, so it's not necessarily all cash out of pocket. That leaves a financed amount of $240,000, and for the sake of this example, we're assuming a 5% APR over 48 months. Now, I know your current rate might be a bit higher than 5% given today's rate environment, but what we're trying to do here is look at this from a long-term perspective. Rates have been both higher and lower in the past, but we're going to stick with 5% for consistency throughout this presentation. Now let's look at how interest plays into your balance sheet over time. For this example, in any given year, the purchaser of this machine could look at his books and say, okay, interest on this machine only cost me $6,000 this year. Not bad. But what we want to consider is total interest paid over the life of the loan. At 5% over 48 months on 240,000, you'll end up paying about 25,000 in total interest. Now that interest is a tax write-off, which is a silver lining, but at the end of the day, that's 25,000 in profit for the bank or finance company. That's what they live on. So think about it. When you swipe your debit card or write a check, the bank doesn't charge you a fee. That's not their game. Facilitating transactions is just a convenience. They're not in business for that. Banks are in the business of lending money. And this example makes it crystal clear. $25,000 in interest is value you've created, but it did not come back to you. It went to the bank. And we're not talking about just one piece of equipment. Depending on the size of your operation, you might have 4, 5, or even more equipment loans active at any given time. So it's not just $25,000 in interest here, it's another 40,000 there, 60,000 over there. Your loader might be one of the more affordable machines, but your feller buncher, your skidders, haulers, front end loaders, those are high ticket items, and the interest stacks up quickly. The good news is your business is profitable. It produces the positive cash flow to make all of this work. You can cover the interest payments on these pieces of equipment and also produce a profit. But if there was a way to keep more of what you earn, to reclaim some of that value, wouldn't it be worth looking into? Banking is one of the most profitable businesses in the world. And if you could participate in that profitability, why wouldn't you? And that's the conversation we're inviting you into today. So here's what we're going to focus on for the remainder of the presentation. We're going to move beyond the basics and start looking more closely at what we actually do here at Chapman Financial, what strategies we implement, and how those strategies can help you run a more efficient and more profitable business over time. Now, just to bring it back for a second, let's revisit the issue of interest. What we've been talking about in regards to how much interest is charged on a singular loan up to this point is just the starting point of a much larger picture. So let's look at what these loans really cost you over time. What we've done here is project those interest expenses out over the course of 38 years, basically a working lifetime of equipment purchases. We're keeping the interest rate constant at 5%. Yes, it will fluctuate. We've seen that already over the last few years, and no doubt it'll continue to change. But for the sake of long-term planning, a 5% average is a fair baseline. Now, something else to factor in is inflation. As you know, equipment doesn't get cheaper. If anything, prices rise every year. That's why in this model, we've assumed a 2% annual inflation rate. So this software allows us to project that data across nearly 4 decades of business operations. So at the top of the screen, you'll see some familiar equipment categories: trucks, loaders, skidders, cut down machines. These numbers reflect the actual financed amounts, not the sticker prices, since we're factoring in a typical down payment. So over the course of this 38-year projection, we're assuming that you'll purchase 5 trucks, each financed over 8 years, then 9 loaders, 10 skidders, 8 cut down machines, each financed over 4 years. All of this is based on realistic timelines for equipment turnover in an active growing operation. And again, all of these purchases are projected to increase in cost at 2% annually to account for inflation. So what's the end result? Running this operation and purchasing that necessary equipment under these assumptions at 5% interest over 38 years results in a total projected interest cost of $1.7 million. That's $1.7 million that doesn't go towards building your business, hiring new talent, upgrading equipment. That is just interest. So I'll pose this rhetorical question. If you could take back even a portion of that, say 10%, would that help your bottom line? What if you could keep 20%, 30%, 40%? So that's what we're targeting here. We're not trying to make your loans cheaper. We're not here to tell you to squeeze out 2 or 3 extra jobs out of your crew every year. We're not even asking you to operate differently. We're simply focused on one thing: changing the direction of where your cash is going and giving you more control over the financing function in your business. So how exactly are we going to do that? Let's take a look. So to really illustrate what we're talking about here, I want to compare the balance sheets between you and the bank when you take out an equipment loan. So let's look at your side first. When you finance a piece of equipment, say a TigerCat 220E, you acquire an asset, which is the machine itself. But at the same time, you also take on a liability, a $240,000 loan with interest. And let's say that interest is 5% on the principal. Now, over on the bank side of the ledger, things look completely flipped. To them, that same 5% interest is not a liability. It's an asset. That's where they're earning their return. Meanwhile, the $240,000 they loaned out to you is their liability. They've written a check from their capital account and they no longer have direct access to that cash. But here's the key point. Even though they gave up the cash, they still maintain control. They hold the title to the equipment until the loan is paid in full. So while it's still sitting in your yard, being used in your operation, technically it's theirs. And if for any reason you fall behind on your payments, say you hit a tough patch and have to miss a few months, they're going to come knocking. They'll reclaim the asset and leave you without the very tool you depend on to generate income. So what we're proposing is simple. Combine both balance sheets in a way that works to your benefit. So by combining the balance sheets, you still acquire the asset, you still make the payments, you still have the loan balance and the interest just like before, but the difference is you own the financing mechanism. You're still putting out that 5% interest, but instead of it being profit for the bank, it becomes an asset for you. That 25,000 in total interest we talked about earlier, instead of sending it out the door, we're working to redirect that cash flow back to you. And more importantly, you retain control. You keep the title. You don't have to mail it off to a lender and wait for it to come back in once you're fully paid off. That means if there's a slow month, if the weather's bad and you can't get in the field, you've got flexibility. You have the option to pause payments without the fear of losing the equipment that keeps your operation going. Because here's the bottom line. If the bank takes the machine, you lose your ability to produce. You lose your cash flow entirely. But when you control the financing, you control the equipment, and therefore your ability to generate income stays intact. And that goes back to one of the core issues we talked about earlier, America's over-reliance on banks and outside lenders. A big part of that is the fact that we've handed over control. So our goal here is simple, to return that control to you to help you keep more of your money and take ownership over the financial engine of your operation. So here's how we're going to make that shift happen. Right now, if you look at the current financing structure of your operation, there are three main players involved. In the center, you've got your business. Over on the left, there's the equipment dealership. And on the right, there's the local bank or lender. Here's how the money flows. So your business receives funding from the local bank in the form of a loan. You take that loan and write a check to the equipment dealer. In return, you get the equipment you need to run your operation, whether that's harvesting, loading, processing, or hauling. As you generate revenue from doing what you do best, you take a portion of that cash flow and send principal and interest payments back to the bank. Now, here's the part that most folks don't think twice about, but it's critical. Once you've covered your expenses, you take what's left, your profit, and you deposit it back into the same bank or one just like it. Now, they might pay you a little bit of interest, sure, but here's the real kicker. You're walking in the front door of the bank with your hard-earned money and making a deposit. Then you're walking around to the back door and borrowing that same money back at a much higher rate because that's what banks do. They take your money, turn around and loan it to someone else, often right back to you, and earn the spread. And while the physical banks you're depositing into and borrowing from may be different, they're operating under the exact same system. So here's the key idea. We're not trying to change everything about your operation. We're not telling you to stop financing equipment or restructure your whole business. We're only changing one thing, where your deposits go and where your loans come from. That's it. So instead of using the local bank, we want you to become the bank. You take full control over the financing function. You're the one making the lending decisions. You're the one benefiting from the interest. You're the CEO, the administrator, the account holder, and the owner all in one. And that brings us to what we're really talking about here, the infinite banking concept. Now, of course, you're probably thinking starting a bank, that sounds like a massive undertaking. And you would be right. Starting a traditional bank is not something most business owners can realistically pursue. It typically requires 12 to 25 million in startup capital and at least a year or more to go through the regulatory approval process and secure a charter. It's a long, expensive, and highly regulated process, well beyond the scope of most operations. But here's the good news. You do not need to start a traditional bank to think and operate like one. That's where the infinite banking concept comes in. What we're talking about is creating a private banking system custom built for your business using a proven, structured financial strategy that gives you all the key benefits of a bank without the overhead, regulation, or timeline of starting a real one. So let's break down how that works and how you can put it in motion for yourself. One of the most effective ways to take control of the financing function is by using a properly structured whole life insurance contract. Now, this isn't your typical life insurance. Traditional life insurance focuses on getting the most death benefit for the least amount of premium. What we're doing is the exact opposite. We want to get the least amount of death benefit for the most efficient premium because that allows us to maximize the cash value, which is what powers your private banking system. So here's how it works. You on the left side fund the policy in two ways, base premium and paid up additions. This money goes into a specially designed whole life policy issued by a mutual life insurance company. Now, the mutual part is critical. Unlike stock companies, mutual life insurance companies are owned by the policyholders, which would be you. That means you're not betting against the company and they're not betting against you. You are financial partners. The insurance company contributes in two additional ways. They provide a guaranteed interest rate and they pay non-guaranteed dividends based on the company's performance. So you've got cash flowing into the policy in four directions: your base premium, your paid up additions, the guaranteed interest, and the potential dividends from the insurer. This creates a powerful compounding asset inside your policy. So once the cash value has accumulated, you can access it through policy loans. You can use these loans to purchase equipment, invest in real estate, buy a vehicle, whatever your business or personal needs are. And then you repay the policy loan with principal and interest at a market rate, just like you would a normal bank. But here's the difference: the interest you're paying is going back into your system, not a third party lender's. So you can access this cash value tax-free at any point. But once you reach retirement age, that becomes an even bigger benefit because it addresses one of the biggest financial concerns today: future tax risks. With the direction federal spending is heading and the possibility of rising tax rates in the years ahead, it makes sense to secure a stream of tax-free income in retirement, not defer taxes into an uncertain future. So that's exactly what the strategy helps you do. You're reclaiming control, building your own bank, and creating a future that's not dependent on external lenders or volatile tax policy. So now let's look at the lifetime impact of implementing this strategy. This is going to be a high-level overview, just a 10,000-foot view to help illustrate how the process works over time. So we're going to walk through a hypothetical example to show the potential value of employing the infinite banking concept in your operation. So let's meet our good buddy John Doe here. He's 40 years old, and for the purposes of this example, we're assuming he qualifies for a select rating, just above standard. So this means the insurance company sees him as a solid risk. We're also keeping our previous assumptions in place: 2% annual inflation and a 5% interest rate on all loans taken from the policy. So now let's look at the premium structure for this policy. For the first 7 years, John puts $50,000 per year into his policy. In year 8, that drops down to $20,000 per year moving forward. What's happening here is simple. His base premium is $20,000 and he's adding a paid up additions rider of $30,000 in the early years. Together, that makes up the full $50,000 annual contribution. So that overfunding in the early years is crucial. It's how you capitalize your system, how you fuel the bank, so to speak. Eventually, the policy reaches a point where the dividends are strong enough that you no longer need to overfund it. That's when it begins to leverage itself and continues to grow with less input. And just a quick note on the policy amount here. I'm showing it with 50,000 a year going in, but it could just as easily be 5,000 or even 500,000. The way the policy works stays the same. The real power is in the structure, not the size of the contribution. So now let's take this strategy and apply it to a real-world operational timeline. So over the next 38 years, John uses his policy to finance some of the equipment his business needs. Slowly at first, as he has to capitalize his bank, but as time passes, he's able to finance a larger share of his operations. In this example, over time, he finances 4 trucks, 7 loaders, 7 skidders, 4 cut-down machines, and 1 shipper. Every piece of equipment is financed through policy loans at 5%, and every purchase assumes a 2% annual inflation, just like in the earlier example. So by simply redirecting the loans he would have taken from the bank back to his own life insurance policy and repaying those loans just like he would have with the bank, the result over 38 years is a net financial impact of $2.6 million. Let me repeat that. John ends up $2.6 million ahead, not from buying extra equipment, not from doing more jobs, not from making high returns elsewhere, not from taking any additional risk, but from changing the flow of money. Just from financing his own purchases, maintaining control, and reclaiming the interest that would have gone to the bank, he was able to produce an additional $2.6 million. And along the way, he gains all of the additional benefits we talked about. He has full control over the system. There's no risk of having his equipment repossessed if things get tight. He has flexibility when he needs it. And when he reaches retirement age, he has access to the accumulated cash value tax-free. This is the power of infinite banking when it's applied correctly and consistently over time. So let's talk about the why behind using whole life insurance for this strategy. You might be wondering, why not just use a checking or savings account to take on more of the financing function myself? Why get a life insurance policy involved at all? So that's a fair question. So here's why whole life insurance, when structured properly, is such a powerful tool. First, it's safe. The type of life insurance company we use is a mutual life insurance company, organizations that have been around for over a century and have thrived through every kind of economic environment. In fact, mutual life insurance companies are considered one of the 4 pillars of capital in America, right alongside Wall Street, the banking system, and the federal government. Of the 4, mutual life insurance companies are arguably the most stable. During the Great Depression, while many parts of the financial system were collapsing, mutual life insurers actually stood out for their resilience. Their conservative investment strategies and strong liquidity positions allowed them to continue operating without disruption. Secondly, these contracts are liquid, so you can access funds when you need them, no questions asked. Thirdly, these policies are contractually guaranteed to grow. There's a floor built into the policy. For example, let's take a look at year 30 of John Doe's policy. By then, he's put in 810,000, but his guaranteed cash value is over 1 million. That's the minimum. That value will be there no matter what the broader economy does. And remember, this is not about the policy alone, it's about the process. The infinite banking concept is not a product, it's the system of flowing money in, flowing money out, paying interest back, and turning liabilities into assets. Another important feature is creditor protection. In many states, the cash value of a properly structured whole life insurance contract is protected from lawsuits, judgments, and liens. If you were ever to be involved in a legal dispute or had a claim placed against you, the funds in your policy cannot be touched. That makes it one of the most secure financial vehicles available. Then there's the strength and history behind these mutual companies that we've already talked about. These are organizations that think in decades, not quarters. Unlike stockholder-owned corporations, they're not chasing short-term gains to impress Wall Street. They're making long-term decisions that benefit their policyholders, not shareholders. That kind of long-range thinking is rare in today's financial world, and it's one of the key reasons why these companies remain stable and consistent. So these contracts also receive a flow of dividends. Earlier, we looked at the guaranteed column. Now let's look at the non-guaranteed side, where annual dividends are shown. Those dividends grow over time and represent your share in the company's profits. As a policyholder, you're part owner. If the company has a profitable year, you participate in that. And here's the kicker. If you do business with a traditional bank, that bank also pays a dividend. It just doesn't pay it to you. It pays it to its shareholders. So what we're doing here is redirecting that value as well. So you become the one earning the dividend. So in addition to all this growth, both guaranteed and dividend based, is tax exempt. You don't receive a 1099 each year, and you won't be taxed on this accumulation if structured properly. It's not like a tax deferred retirement account where it builds up tax free, but you pay tax on it in the future. Or if you need to access it before retirement, you are penalized on withdrawals. This cash in your policy is liquid and accessible at any time with no age restrictions or government imposed timelines. And then moving on, this is life insurance. So, of course, it also provides a death benefit. And while the focus here is on the living benefits of the policy, the death benefit still plays a significant role. It's not stagnant either. It grows over time and often outpaces inflation. For example, if John's policy starts with a $1.1 million death benefit here, it could grow to $2.7 million by year 30. That growth ensures that your legacy is preserved and continues to benefit your family or business after you are gone. These policies also provide long-term care benefits. If at any point you're unable to perform 2 of the 6 basic activities of daily living, the death benefit can be accessed while you're alive to help cover those care costs. And finally, one of the most valuable benefits is flexibility. When you own the financing system, you have the power to pause or shift as needed. If you hit a rough patch, say poor weather shuts down operations and revenue slows, you're not at the mercy of a third-party lender. You don't risk losing your equipment or being penalized. You're in control. And very few businesses can say they have that level of flexibility. So if you fully implement this strategy, you'll give your business a level of resilience that's nearly impossible to achieve through conventional banking. It's not just about making money. It's about keeping control of the money you already earn and using it more efficiently, more safely, and more strategically. So let's keep moving forward and continue to break down why we use whole life insurance in this strategy. So we've been over some of the conceptual benefits, but let's look at the monetary benefit. Because you might be thinking, okay, I like the concept. I want to take more control of the financing side of my business, but why does it have to be whole life insurance? Why can't I just do this with another asset class? And that's a great question. So let's walk through it. Let's start by comparing the same behavior to a more basic option, storing cash. So let's say you keep cash in a gun safe or a shoebox at home, and you fund that shoebox just like you would the life insurance policy. $50,000 a year for the first 7 years, and then $20,000 per year after that for a total of 38 years. Now you're going to be using this cash just like we would have in the policy to finance equipment purchases. 4 trucks, 7 loaders, 7 skidders, 4 cut down machines, and 1 chipper. Each time you need to make a purchase, you'll pull the funds from the shoebox and use it to buy the equipment. You'll then pay that amount back in the shoebox with 5% interest, just like you would if you borrowed from a bank. And we're also going to assume 2% annual inflation. So what happens? By the end of the 38-year period, if you just stored the cash and did nothing else, you'd have around $970,000 in that shoebox. But by simply adding the infinite banking concept, borrowing from yourself and paying yourself back with interest, you'd end up with $1.797 million. That's without any market growth or interest earnings, just disciplined repayment. Now, of course, there's a few obvious flaws here. First, a shoebox does not pay interest, so you're missing out on income that you could be earning. Secondly, what happens if your house burns down? Shoebox is going to go up in flames too. So you might say, well, instead of using the shoebox, I'm going to use a savings account. So let's look at a savings account. Now, in this example, I'm going to assume that the savings account will earn 1.8% every year over the course of 38 years. And that's actually a little bit higher than the historical average of 1.6%. We'll also factor in taxes on interest earnings at a 25% rate. So in the savings account, you'll follow the same process, funding the account, financing equipment purchases, paying the loans back with 5% interest, and adjusting for 2% inflation. In this case, at the end of 38 years, you would have $2 million. That's better than the shoebox and better than not practicing infinite banking at all. So if you're comparing these two options, the savings account wins. But now let's look at the same process applied to a whole life insurance policy. Same funding, $50,000 per year for 7 years, then $20,000 annually after that. Same equipment purchases, same repayment, same inflation rate, but now you're doing it all through a properly structured whole life insurance contract. So at the end of the same 38-year period, you'd have 2.67 million accessible tax-free. That's nearly 700,000 more than the savings account and more than 1.7 million more than the shoebox strategy. And that's the monetary benefit. So I've already mentioned that you also gain a range of other financial advantages. Whole life insurance offers safety and liquidity. It comes with contractual guarantees for long-term growth, along with creditor protection. Your cash value is backed by the strength of a mutual life insurance company that's historically stable and reliable. On top of that, you receive annual dividends, experience tax-exempt growth inside the policy, and gain access to your funds tax-free throughout your life. It also provides a growing death benefit that adjusts with inflation over time, ensuring your legacy is protected. And if you ever need long-term care, these policies provide living benefit provisions that allow you to tap into the death benefit for care expenses. Most importantly, the system gives your business a level of flexibility that very few companies ever get to experience. Not only are you producing more money over the long term, but you're doing it in a way that strengthens your business, gives you access to capital on your terms, and reduces dependence on banks and market volatility. That's the power of combining the infinite banking concept with whole life insurance. And that's why we use it as the financial foundation in this strategy. All right, so I know I've gone over a lot, and I want to take a moment to wrap this up with a quick summary. At the top of the slide, you'll see the phrase two-sided coin, and that's really what the strategy is all about. So right now, your business operates like a one-sided coin. Your day-to-day operations, harvesting, loading, processing, and hauling logs, generate your income. You're running a strong business. You're covering your overhead, paying your employees, meeting your tax obligations, and handling your liabilities. And that's great. There's absolutely nothing wrong with that. But there's another side to your business that often goes untapped, the financing side. So right now, someone else is making money off of that side. The banks are financing your equipment purchases. They're using your need for capital as a way to earn interest and grow their own business. In their model, you are the asset. You're the borrower and the debt instrument that drives their returns. So all we're trying to do is flip that coin over and help you start profiting from the financing function of your own operation as well. We're not asking you to change your day-to-day operations. We're not asking you to take on more risk or more strain. What we're offering is a way to monetize your business in a second way by adding a private banking function that you control. With this strategy, you can start financing your own equipment purchases. You can create tax-free retirement income, provide greater control and flexibility in how your operation is managed, offer your family a tax-free death benefit, and even gain access to long-term care protection, all by flowing your capital through a system that you own. This is not about replacing your current business model. It's about making it stronger. It's about reclaiming value that you're already creating and putting that value back into your business, your family, and your future. So after walking through all that, I want to pose these few questions. In order to provide your business with more control, more flexibility, and more profit in the long term, did we have to change anything about your operation? Did you have to work any harder? Did you have to take on more risk, like chasing a 10% return out in the market while exposing yourself to a potential 20% downturn? The answer is no. We did not have to do any of that. All we did was take part of your business that was already in motion, the financing side, and redirected it in a way that puts you in control. So if any of this sparked interest, if it made sense, if it felt relevant to your situation, let's talk. Let's set up a time to walk through this strategy and how it could work for you specifically. So I appreciate your time, and I look forward to the opportunity to help you take your business to the next level. Thank you. Let me repeat that.